Coming up on the show, Zimbabwe to circulate higher banknotes as inflation soars. Egypt's unemployment falls in first quarter. And Facebook and major telecom companies plan subsea cable to connect Africa, Middle East, and Europe. Thank you for joining us and welcome to Business Incorporated. I'm Chimezi Obi Iwag. We'll begin the show with intraday market numbers. They were positive. South Africa's JSE index gaining the most by 1.15%. Nigeria's benchmark index rose 0.21%, led by the 0.77% increase in banking stocks. The Egyptian index closed for the week negative by 1.1% on Thursday. And most stock markets across the Gulf region closed for the week negative on Thursday as the Organization of the Petroleum Exporting Countries and International Energy Agency estimated lower demand for crude in 2020 due to the impact of the COVID-19 pandemic. In Dubai, the index contracted 1.39%, with Emirates MBD Bank falling 3.4% and blue chip developer Emma Properties shedding 1.2%. Only Abu Dhabi's index ended 0.20% higher, helped by a 2.8% rise in telecoms for Etisalat, while gains were capped by a 0.9% fall in First Abu Dhabi Bank. The Qatari index slipped 0.75%, with Industries Qatar declining 2.9%, while Saudi Arabia's benchmark index slipped 0.06% as petrochemical maker Saudi Basic Industries dropped 2.2%. In Europe, markets advanced on Friday morning as investors pinned their hopes on economic reopening efforts and a host of key first quarter data. Well, let's bring in Chelsea now to tell us more. Hello, Chelsea. Good afternoon. Well, stocks bounced back on Friday as concerns over the global economy eased heading into the weekend. What's driving markets in Europe today?
There are a lot of different headwinds and a lot of different tailwinds in markets today. It's a busy Friday. Overnight, there was some data out of China showing a big bounce back in industrial production, which has really helped spur hopes that other economies could follow in China's footsteps and maybe in a few months be back to posting strong growth in their industrial sectors. This also helped propel oil higher because China is a huge importer of oil, and the shutdowns in their industrial sector have really cut off demand. So that all helped spur hopes that the economy was getting back on track. But there have been more reports of increasing tensions between China and the U.S., which has taken some wind out of this optimism heading into the afternoon. So the DAX was up almost 2% earlier. Now it's down, or now it's only up about 1%.
Now, talking about data today, government reports showed the German economy shrunk 2.2% in the first quarter as coronavirus lockdown slammed growth. How much worse could the economic slowdown get?
It's certainly going to get worse before it gets better. Most of the impact of the coronavirus-related shutdowns are going to be felt in the second quarter. So the data released today, it only goes through March, and Germany really only started shutting down the economy in the middle of March, so it only has about 2 weeks of those impacts included in it. So the second quarter is really where economists expect to see the biggest and most dramatic declines. Most economists are forecasting a contraction somewhere around 10%, something it could be as high as 15%. But as the economy does reopen here, as we see stores open, as factories get up and running again, it is expected throughout the rest of the year to see the economy strengthening again, but not enough to save Germany from a recession this year. The overall forecast is for a decline in the yearly growth of about 6%. So still a lot of difficulties ahead.
And trade tensions are ratcheting back up between the U.S. and China as President Trump threatens to cut ties with its largest trading partner. Are investors taking that threat seriously?
Investors aren't taking that specific threat very seriously. It's not entirely clear what that even would mean, cutting ties with China. But it certainly is a sign that things are getting worse between China and the U.S. China is the U.S.'s largest trading partner. They do about $700 to $800 billion worth of trade every year. So it's not clear that they could completely cut ties. But what the U.S. can do is create more pressure on Chinese companies and on Chinese financial markets. So today we saw China ban, or the U.S., the Trump administration banning the export of semiconductors that would be used by the Chinese telecom company Huawei. That's really spooked investors, but they also the United States is also starting to push back on this trade deal that they struck earlier this year. So this is certainly a major geopolitical concern for investors, especially at a time when the global economy is on such weak footing.
Well, Chelsea, it's been a good week with you. Let's continue to stay safe. Enjoy the weekend. And in the UK, figures from the Office for Budget Responsibility shows that the mounting cost of government schemes to help Britain through its worst recession in more than 3 centuries has risen by £20 billion in the past 2 weeks and will result in a budget deficit of nearly £300 billion in the current financial year. Let's bring in Juliana now to tell us more. Hello, Juliana. Good afternoon. Well, you spoke to BC this morning about Transport for London securing £1.6 billion funding, but TfL has come out to say it is facing a £3 billion finance gap this year owing to the coronavirus pandemic, suggesting it may need more cash from the government. Can the government really afford this, considering that the cost of government schemes are already on the rise?
Good afternoon, Chimeze. Well, the government certainly can afford it, but whether or not they want to pay for it remains an open question. As you just stated, some budgets there from the Office for Budget Responsibility saying that the cost to Britain's GDP from COVID-19 could be up to £300 billion. So far, the government have actually just spent £100 billion, which is about 4.5% of the overall GDP, not as much as America, that I believe have spent up to 10%, but still much more than their other European countries. So there's a lot more money in the coffers, but it's whether or not Britain wants to spend it. And of course, they do want to maintain themselves as one of the strongest G7 economies and one of the wealthiest countries in the world. But going back to TfL, there's currently a storm brewing between Londoners and the Mayor of London, Sadiq Khan, as well as government. They did secure that £1.6 billion worth of funding last night from the government to keep them ticking over because they've lost about 95% of the revenue. But just hours after they did agree that settlement with the government, the Mayor of London has actually decided to extend the congestion charge hours and increase it. So at the moment, if you're driving into central London, it will cost you about £12.50 just to drive in. That's going to increase to £15, and it will increase from Monday. So far, there's been no congestion charge because the government have been pledging and urging people to drive into work. But because of the lost in funds, and Sadiq Khan said the government didn't give him enough money, he says he's had to extend that. And it kind of goes against what the government's been saying because they've been asking people to avoid transport. But I think it's pretty certain that nobody really can afford £15 to drive into work. Even to park in central London, it costs about £50 to £60 a day. So there's a huge clash there. He's also said that the congestion charge will now be extended by hours. So it usually finishes at 6 p.m. This will now go until 10 p.m. And it will also be on the weekend. So I'm sure all of our viewers in London will be pulling their hair out because the congestion charge for many, many years has been a sore thumb when it comes to mayoral elections. And now Sadiq Khan is having to really increase it and take it to costs that are almost astronomical. The debate continues.
We continue to watch and see how that plays out anyway. Well, Royal Mail Chief Executive Rico Back has stepped down with immediate effect. Why this sudden move by Back?
Well, it was sudden, but the markets were not surprised, really. Bark has been at the head of Royal Mail for 2 years, but he's been with the service for about 30 years. It's been pretty strained in the past couple of years. Royal Mail have had some pretty nasty spats with unionists. Unionists believe that staff haven't been paid well, they haven't been looked after, and there were concerns that were bullying. So there have been, over the past couple of years, some quite public, notable protests and stoppings of work. But recently, during the pandemic, there was also further complaints that staff were not given enough personal protective equipment. As everybody else was in lockdown, particularly delivery businesses, they were exceptionally busy, and a lot of their staff just didn't feel safe at work. Last month, Royal Mail also dropped sales. About £22 million was lost in their letter delivering service. And this is what Bark was really overseeing. Royal Mail transforming from a letter delivery service to more of an online delivery service, trying to compete with the likes of the giants such as Amazon. That's still ongoing, but the relationship between Bark and unionists wasn't improving. Also, there were reports a couple of days ago that whilst his staff were, battling it out on the front line, trying to deliver letters to individuals, he was running the firm from his Lake Zurich fronting home in Switzerland. So that didn't really appease anybody. As soon as he announced his departure, their shares were up by about 8.5% this morning, which is a huge increase because under his tenure, Royal Mail shares have dropped historically low. So sad to see him go, but not sad for everyone.
All right, talking about the markets now, the FTSE 100 gained 1.4% in the opening minutes of trading, while the FTSE 250 was up 1.3%. What are the intraday numbers saying, and what is the outlook for next week?
Well, one of the main drivers on the FTSE this morning is Bark's departure. So Royal Mail, their shares were up 8.5%. At intraday, the all share is up 0.83%. The FTSE 100 is up by 0.67%. And the FTSE 250 is up by a whopping 1.31%. In currencies, the pound is also doing well. Actually, not doing well on the dollar. It's down 0.26% on that. Also down on the euro by 0.34%. And down on the Japanese yen by 0.51%. I suppose next week, what we're all going to be looking out for is those flash PMI numbers, the Purchasing Managers Index, which is going to give us a really good analysis of how the economy has been doing in manufacturing, construction and services. It was pretty dire in March. We're thinking it's going to be abysmal in April. And so lots of people will be focusing on that. We're expecting a 25% drop of GDP in Q2 for the British economy. So these PMI numbers will tell us if we're heading in that direction, or it could even be worse, Chimay.
Well, we look forward to those data there. In the meantime, let's continue to stay safe and enjoy the rest of the weekend. And stocks in Asia were little changed on Friday as data showed China's industrial output bouncing back more than expected in April. Mainland Chinese stocks were mixed on the day, with the Shanghai Composite slightly lower at around 2,868 points, while the Shenzhen Composite added 0.159%. Hong Kong's Hang Seng Index hovered around the flat line as of its final hour of trading. In Japan, the Nikkei 225 closed 0.62%, while the Topix Index rose 0.5%. South Korea's Kospi added 0.12%. Shares in Australia saw gains on the day, with the S&P ASX 200 up 1.43%. Overall, the MSCI Asia ex-Japan Index gained 0.19%. And U.S. stock futures edged lower on Friday morning following a sharp rally a day earlier as investors awaited a key reading on the retail sector. Dow Jones Industrial Average futures fell 69 points. S&P 500 futures and Nasdaq 100 futures also pointed to negative opens. The Dow rallied more than 300 points, while the S&P 500 gained over 1% on Thursday. The Nasdaq Composite advanced 0.9%. Gains in bank and energy stocks lifted the major indices, while shares of major tech companies such as Apple and Alphabet added to their recently massive gains. Despite those gains, however, Wall Street was headed for its biggest weekly decline since late March. The Dow and S&P 500 both ended Thursday's session down more than 2% for the week. The Nasdaq had lost nearly 2% week to date. And when we come back after the break, we'll look at Moody's rating of 3 banks in Kenya. Do stay with us. Moody's Investor Service has affirmed all ratings and assessments of the 3 rated Kenyan banks. They are KCB Bank, Kenya Limited, Equity Bank Limited, and Cooperative Bank of Kenya Limited. As part of the same rating action, Moody's has changed the outlook on the bank's long-term deposit ratings to negative from stable. The rating action follows Moody's decision to affirm Kenya's B2 government rating and change its outlook to negative from stable on May 7. And the negative outlook on the sovereign reflects the rising financing risks posed by Kenya's large gross borrowing requirements at a time when the fiscal outlook is deteriorating. Let's talk to a bank analyst and the CEO of Core Street Research and Analytics in Nairobi, George Bodo. Good afternoon, Mr. Bodo. Thank you for joining us.
Good afternoon.
Now, according to Moody's, the affirmation of the 3 Kenyan banks' ratings reflects their resilient financial profiles despite the increasingly challenging operating environment. What do you make of this rating of these banks?
Well, what Moody's has said is that they are actually affirming the risk score of those 3 banks from where they are, but at the same time, they are actually changing their outlook on the banks. Primarily on the fact that the 3 banks are heavily exposed to government debt. In fact, they're talking about the exposure being at 1 to 2 times their capital, which is they think it's very risky, and primarily because the government's fiscal trajectory is not looking good. What they're simply saying is that there's a chance that the government can default on their debt, and hence why they're changing their outlook. But they're actually right, because for 2 reasons. One is that the government's fiscal trajectory is actually looking quite weak. And this is because the government is increasingly being weighed down by debt service, especially on the domestic and external side. We've also seen actually on the same length, the IMF has also downgraded Kenya's risk of debt distress from medium, which they did it in 2018. In 2018, they classified as medium. They came back this month and said that the risk of debt distress is actually now very high, but they were largely hinging on the external debt side. So a couple of issues here that Moody's are playing into, but also something which might have spooked them, Moody's, is the fact that a couple of weeks ago, the government jumped onto a proposal by the private pension scheme sector, that they wanted the government to allow them to roll over interest on certain portion of government securities that they were holding, which actually amounts to a reverse default. And probably Moody's might have also jumped on this, because essentially, which the government actually, by the way, has allowed it, they've allowed the holders of particular debt to roll over interest by way of issuing a new debt instrument. They've actually issued a new infrastructure bond with a tenure of 6 years, priced as 10%, which invites all these holders of debt to roll over their interest. This amounts to reverse default. I think it's massive.
Okay, Mr. Bodo. Now let's look at these banks, specifically KCB and the likes of it. What makes these 3 different from the others, that have driven this ratings, looking at the rationale there?
So they're saying that, for instance, they're citing KCB, Equity, and Cooperative Bank, which have been tier 1 banks. They have the large exposure to government securities. By the way, the reason why these banks have a huge exposure to government securities is because for the past 3 years, they've not been lending. And they've not been lending primarily because there was a law in place that came into being in 2016 that basically capped interest rates at the point at which they can price loans. So the classic response from most of the banks, and especially the large ones, was to slow down on lending. And they've been sitting on so much liquidity and nothing to do with this. So what they've done, and specifically Equity Bank, which operated in the risky segment of the market, which is the SME and the household lending, the micro businesses, they simply put a moratorium on lending. And they said, at one point, the CEO of Equity Bank said they're going to continue buying treasury bills and treasury bonds. And this is why the three of them are mentioned, are cited in that downgrade by Moody's. But also the other reason is that they are the only banks that have ratings from these international majors, actually.
So what's your general assessment of the Kenyan banking industry, particularly at this time of COVID-19?
I think the outlook for me, I would agree with even my own assessment, the outlook is quite negative for two reasons, actually. The top reason is for me is the fact that loan performance is likely to deteriorate in 2020 through to 2021. In some quarters, like for instance, a survey done by Kenya Bankers Association shows that gross NPL ratios could rise from 12% where they were in February to 14% by end of the year. I think it's going to be high. I think I'm seeing levels of 18% by the close of the year. So for me, the asset performance is a big issue because the entire sector the entire segments where they operate, most banks operate, the SME, the micro businesses, the household, personal lending, have been negatively impacted by COVID-19. So for me, the outlook for NPL's asset performance is quite, and also if you look at what the central bank said, they actually asked banks to give moratorium on debt service for distressed customers, and that a lot of customers are very much distressed. Actually, as I bought a week ago, the numbers were that banks had restructured loans amounting to about $1 billion, which is a big portion, by the way, for the bank. The second issue, obviously, is the exposure. I'm also getting concerned about the exposure to government debt because the government is increasingly looking like they're distressed from a liquidity perspective. So I actually think that they now need to start providing capital for every government debt they're holding. Previously, government debt is considered to be risk-free, so they were not holding any capital. So I'm also getting concerned about that.
All right, Mr. Bodo, in just 30 seconds, the central bank, of course, is billed to have its rate-setting meeting. That's on the 27th of this month. What are your expectations in 30 seconds, please?
The Monetary Policy Committee meeting in the next month's meeting, I think for me, they would actually hold the current stance. I think they need to give some time for because remember, in the April meeting, they cut the policy rate by 100 basis points. They again cut it about by 50 basis points. I think they need to give it time for the actions to seep into the economy. So I think they will likely hold.
All right. Thank you very much, Mr. Bodo, for your time. George Bodo is the CEO of Core Street Research and Analytics in Nairobi. And Zimbabwe will introduce higher denomination banknotes to increase the amount of cash in circulation at a time inflation is soaring and pushing prices beyond the reach of the majority. The Southern African nation brought back the discredited Zimbabwe dollar currency last year in June after a decade of dollarization. The move failed to end severe cash shortages and unleashed inflation, which reached 676.39% in March, one of the highest in the world. Inflation is seen ending this year way above the central bank and Treasury's target of 50%. And Egypt's unemployment rate declined to 7.7% in the January to March quarter from 8.1% a year earlier. But the rate had risen to 9.2% by the end of April, up from 7.5% in the second quarter of 2019, as the coronavirus pandemic hurt the economy. The state statistics agency, CAPMA, said it stopped collecting field data for the first quarter in mid-March before the government began taking coronavirus mitigation measures that slowed the economy. And Facebook and a team of African and global telecom majors have struck a deal to build one of the world's largest subsea cable networks, boosting internet availability across 3 continents. South Africa's MTN Global Connect and Mauritius-based infrastructure provider WCC are partners in the project, along with China Mobile International, French telecoms major Orange SA, Saudi Arabia's STC, Telkom Egypt, and Vodafone. The project, called To Africa, aims to build 37,000 kilometers of subsea cable infrastructure, which will directly connect countries around the African coast to Europe and the Middle East. And that's a wrap on the program for today and, of course, for the week. Thank you for being part of it. I'm Chimezi Obi Iwago.